Hey, Anthony, thanks for joining the Bainbridge podcast.
Great to be here. Can't wait to chat. Been looking forward to it.
Oh, good. Well, today we have Anthony Choe, who's the founder of Provenance, one of the leading PE funds based out of LA. Has a fantastic finance background. Started as a young analyst at DLJ, which dates me because I know what that means.
For
And then
sure.
went from there to Brentwood Associates, which is a legendary PE fund, also based in LA in the consumer space. And then you started Provenance. I'd love to kind of hear from you what led you down that path. What led you to start Provenance, and then we can dive into what you guys do after that.
Yeah. So thanks for the quick summary on the background. But yeah, it's been a fun journey starting off as a financial analyst in New York in the mid '90s at DLJ, as you'd mentioned. Great place to be. Still have a lot of friends from that era, and lots of whom are doing super interesting stuff. So I'm lucky to have been part of that. But yeah, originally started by getting a random call when I was at my desk when I was at DLJ. Somebody from Brentwood called me, asked me if I wanted to interview, and my first response was, "Who?" I had no idea who Brentwood was, but I heard two things. I heard LA and private equity, and since I had originally grown up in Southern California, I knew I wanted to get back to LA and do private equity at some point. I wasn't looking to leave New York at that red hot moment of my career, but uh, back in 1996, you could count on one hand how many private equity firms were in LA. So I
Yeah.
said, don't look a gift horse in the mouth. This is a pretty fun opportunity. So I went there in '96 and was fortunate to have risen through the ranks fairly quickly there. And by around 2006, I became the right hand to the founder, and um, I had some very specific views on how I thought the consumer space was going to evolve, and I had a very firm view that it was going to be all about omni-channel. I'm not even sure the word omni-channel existed back then. Maybe
Yeah,
it
you
was just
just
starting to
coined
be
it.
used.
Yeah.
I think the way I described it was a mouthful back then, which was multi-channel brand selling direct to the end consumer, which omni-channel is a much
Catchy.
easier way to say that. But I was so passionate about this, I focused the entire firm on that strategy. And to try to explain this strategy to our LPs, I wrote a 120-page white paper deck explaining why we thought the world was going to evolve in this direction. Um, my guess is all of maybe two LPs actually read the white paper deck, uh, but most of the LPs, I think, gave us the benefit of the doubt that we had done our homework, and even though they didn't quite understand it, that it sounded compelling, and they just believed that we believed it. Um, so it was the right strategy, very much so. We became known as the first firm to really specialize in that area, and it was brands doing everything from physical retail to e-commerce to catalog, wholesale, and trying to put all those things together. And the whole thesis was, and still is today, for what we're doing at Provenance, that omni-channel is really complex, and it's really hard for any one company to master every channel. And so our view was, when I was at Brentwood, that any great brand that we come across is going to need help in at least one, but likely more channels
Hmm.
that they're looking to expand into. And if we can be helpful in some of those areas where they're looking to expand, then we could differentiate ourselves. And so that worked extremely well. So for the next 10 years, we went from being a $400 million fund to a $700 million fund. And come 2016, we had a pretty good idea that the next fund would be a billion plus. Um,
Nice.
I was very strongly of the opinion, though, that while omni-channel was taking hold, at the same time, what was happening was brand fragmentation in every category of consumer spending. And I felt like that was going to be a permanent state of things. Part of that was what digital was enabling customers uh, or companies to do in terms of reaching their end customers. But what really started to happen, in my view, was that brands were really starting to form around tribes, not
Mm.
categories. And to me, that was kind of a whole new uh, uh, set of circumstances that was going to change what brands needed to be in the minds of their consumers. Omnichannel was still going to be the way you have to reach those customers, um, but to me, that was a fundamental shift that was going to continue to give the advantage to smaller, more narrowly focused brands than bigger brands trying to be all things to all people. So that was a long story on how Provenance got started, but it was based on that premise that we launched Provenance. That uh, the world was going to the sweet spot for brands was going to shift towards a world where you had to go slightly earlier than
Yeah.
traditional private equity. You had to be willing to take minority stakes as opposed to majority stakes, but you still had to be value add to your portfolio companies. So that's the why we're doing what we're doing. Um, in terms of the how, uh, before just launching Provenance, I spent about 6 months going into the proverbial lab, which was some combination of my garage and man cave, um,
Yeah.
stitching together a bunch of the analytics tools that we're using today. So
Yeah.
my view was if brands are going to be formed around tribes in the future, then you have to be really precise about who that tribe is and what their behavior is. So a lot of the analytics tools that we're using today are with that in mind to help brands really focus on their tribe. And by tribe, just to demystify it a little bit, what we're talking about is who your core customer is, and not just from a demographic perspective, but also from a psychographic perspective.
Hmm.
So
I,
so that's
sorry.
that's why we're doing what we're doing today. So
Yeah. Well, thank you for that. I, well, the first time we spoke and you started talking about tribes, it like blew me away because it just made so much sense. And I would really love for you to go deeper on that. Why were brands always building tribes and they didn't realize it, or was there something that shifted with the internet that you could build tribes? Like what caused that insight, and
yeah,
what is a good tribe, or what do you really mean by a tribe?
yeah. So I guess what I'm gonna say about tribe is that when we say tribe, it's really there's a demographic and psychographic profile that we see that's created at a pretty early stage of a brand. So you know, by the time you're about 10 million or so of revenue, that tribe really starts to get locked in. And what
Hmm.
we've seen is that brands as they've gone from 10 to 50 to north of 100 million of revenue, they've expanded their products, they've expanded into a bunch of different channels. uh, we frequently get asked by brands, hey, can you update some of the analytics you did for us? We've grown in a lot of different ways, surely our tribe must have changed, and it almost never does. It's the same group of people, and you're just penetrating them more deeply with
Hmm.
uh, more products and more channels. So, what is a tribe? Uh, a tribe is as much of a psychographic as it is an age group. So, for example, lots of times we'll see certain brands have a very heavily progressive customer base, and other
Hmm.
brands have a very heavily conservative customer base.
Hmm.
Um, Not that we're political in any of the decisions we're making. We don't care one way or the other. We just want to know who it is. But um, the
So, like
tribes
a
are being
black
formed around.
rifle. Sorry to mean to interrupt,
That's
but
right.
like black rifle would pin the needle on the conservative, and I guess you get a handful
You
of
got
brands
it.
progressive. Okay. Yep. with you.
You got it. And so it's as much of a psychographic, a mindset, as it is, a certain need. And so I don't know. I kind of go back to Maslow's hierarchy, and it really feels like from a brand perspective, we're now at that pinnacle of the hierarchy, which is it's not about exclusivity, it's not about just needs and wants, it's about self-actualization. And what
Hmm.
we see is that customers want to see in brands a reflection of themselves, what their value systems are, what their sense of humor is, what their sense of aesthetic is. All these criteria that we would use almost to pick our friends, people are using to pick their brands. And that's what
Yeah.
we mean by the tribe. And that's why I think it's incredibly difficult for, you know, large brands trying to be all things to all people to mean anything. Um,
Yeah.
uh, uh, by trying to be all things to all people, you end up meaning nothing to everyone. And
Yeah.
so we feel like more narrowly focused brands, narrow focus doesn't mean you're going to be tiny, but more narrowly focused brands have a much stronger likelihood of having strong resonance with a particular customer base. And it's that resonance, not just on the initial trial, but repeat purchasing, being really loyal to a brand that matters to get to scale.
Yeah.
And so what we see is that, in every category of consumer spending, it doesn't matter whether we're talking about beauty, apparel, home, fitness, every category is fragmenting into tribes.
Hmm.
And it's those kinds of dynamics that we spend a lot of time looking at because we know those tribes don't change. And I think the hardest conversation for brand founders to hear often from us is that here's your tribe and you're not going to appeal to everyone. And by staying focused on these folks, you're just going to be a better version of yourself.
Yeah.
And so we try to we try to talk about that as you don't have a TAM, you have a tribe.
Yeah.
And the tribe is your customer base. The entire TAM never is. So stop worrying about all the TAM that you haven't reached yet, because
Right.
nobody ever reaches that. So,
I can imagine.
so yeah,
Sorry.
yeah. Go ahead.
I can imagine the that conversation getting a lot of pushback. Like,
Yeah,
because you're when I mean by tribe, you also must have a sense of how big the tribe is, or some way to size it. I would think, right? Okay.
yeah, yeah. So we'll know what kinds of uh, psychographic types they're strongly appealing to across the U.S. Um, and we'll know how many folks are in that particular psychographic. Uh, so yes, we think more accurately size a company and its potential size than just doing a top down exercise. Because the
Right.
example I always give to people is okay, like pick apparel. You can you can say that that's a $400 billion market. You're not going to grab 1% of that. So
Right.
why does the TAM even matter? What matters is who you're resonating with within that giant marketplace. So focus on those folks. Um, and the other part of what we do is quantifying the tribe's behavior. So
Yeah.
not just identifying who they are, but also saying what is it, what does their behavior look like? And most people are surprised when we show them that with our analytics tools, we'll show them that typically 30% of their customers are driving 80% of their profit. And again, the immediate reaction often is, "Holy crap, we have a customer concentration problem." And I say,
Yeah.
"No, you don't. Um, every brand that has any kind of customer loyalty always has this dynamic."
Yeah.
And we get so used to looking at average customer behavior that people kind of miss the mark on the fact that there is no such thing as an average customer. The
Yeah.
average is usually comprised of lots of low value one-time customers who will try your product once, probably really like it, but not fall in love with it and not become part of that tribe. And that's okay. You're always going to have those folks. You're always going to have that trial. Uh, but your entire business is built off of the tribe because they're the ones that keep coming back. And when they keep coming back, that's what drives the profitability and the foundation to build into other channels. And most people will still try to resist this notion
Right.
until I tell them that I don't know if this is still the case. This was years ago, but had this had this conversation with the former CEO of Lululemon, and this person said, "Thank God, we thought it was just us, but when we did the analysis, we saw something like 17% of our customers generating 77% of the profit." And
Wow.
I said, "That's exactly what I would expect to see. In fact, the more loyal your customer is, the more of that dynamic you're going to see." So when we talk about defining the tribe, it's not only understanding what what their value systems are, the types of things they care about, but also what their behavior is. Once
Yeah.
you can combine those two things, then you have a really tight focus on where you can go, who you can be, and what you can expect regardless of what channel you go into. So that's been I think, the unique perspective that we come at it with,
Yeah.
and um, I think most brands find that pretty enlightening because we're telling them things that usually they've never heard before.
Yeah. All right. You dropped a ton of amazing stuff there. So I'm going to rewind a little bit.
Sure.
In the sizing exercise that you've determined the brand, excuse me, the tribe. Now, would you come out of that and say, "Hey, there's whatever 330 million Americans, and we think your tribe is 12 million or something like that"? I mean, does it get like that level of detail?
Yeah, for sure.
Okay.
So I'll try to protect the confidentiality of our portfolio companies, but let's just
Yeah.
say there's one company that we looked at where we said, okay, there's about 71 or so different psychographic types in the US, somewhere between 66 and 71, depending
Okay.
upon when you measure it, how you measure it, etc. Uh, of those 71 types, we showed them that four household types account for 50% of the aggregate lifetime value at the company. And
Huh.
they almost fell out of their chairs with terror, saying, "That sounds really small."
Yeah.
And and we said, "No, it's actually not the case. You're actually appealing to the most sophisticated brand buyers across the country, and they're the ones that are most capable of continuing to spend with you. So the aggregate number of customers that we could potentially have, we're not in danger of running out of them anytime soon. But what we can do is, because your tribe is so precise, let's talk about all the ways we're going to go reach them,
Yeah.
and how we're going to do that in physical retail, which site selection we're going to use to go to the neighborhoods that their tribe resides in and spends most of their time in, what wholesale partners they should be thinking about as a perfect fit for that tribe. It was really about refining the strategy,
Yeah.
and they've really not found the end of it. That company 4 years later is now 4x the size of
Nice.
when we invested, and they still haven't run out of customers.
Yeah.
Even though it sounds really narrow, it's not.
And,
It's deep.
and are they maintaining that power law of value, like the 20% or less is driving 80% plus? Interesting.
That that part has remained
Huh.
remarkably consistent. So their lifetime value has been increasing over time as they've thoughtfully expanded their product assortment.
Yeah.
Um, they've got better at optimizing each of the channels that they're in. um, so they've gotten better about being more relevant to
Yeah.
that tribe in a variety of ways. And so it's not gotten in the way of scale at all. And not only is it 4x the size, now it's very highly profitable and consistently so.
Right. You said in the Lulu example, I think it was like 17% with 77% of the revenue or value. I don't remember which. Um, and then you made the point that like the most loyal, the brands with the most loyal tribes actually have even more of a power law. I think that's what you said. So are you saying that like
Mm-hmm.
if you saw a company that was like, hey, 5%, 95%, you'd be like, aha, like these guys really nailed it? Or would you would that wouldn't make you worried?
Uh, if it's too narrow, I guess that's somewhat problematic as well, because
Okay.
it shouldn't be just 5% of your customer base.
Yeah.
But that power law is always going to exist. The most of the profitability is coming in the long tail of a smaller number of but extremely valuable, highly loyal customers.
Yeah.
We've yet to see an exception to that rule.
Interesting.
And it doesn't matter whether you're a subscription business, just traditional e-commerce, retail. It always has existed. It's just we're able to see that very granularly now.
Yeah.
So on my bookshelf back here, there's a book called How Brands Grow that is
Yeah.
quite old. Um, in that book, and this is decades old research, somebody had actually spent the time to look through the buying behavior of Coca-Cola.
Okay.
And when they actually looked and spent the time at the customer level, who was buying the most Coke, the same power law existed. It's just that all of it is masked by the channel level data. But
Yeah.
now that we have this customer level data that doesn't mayonnaise out uh, and average out just from a
Yeah.
channel level, where we can actually see what's happening at a customer level, this all becomes extremely clear. And it's
Yeah.
always been true. We can just be more precise about it now.
Yeah. So then what's the sweet spot for provenance? Is it's identifying these brands with good tribe dynamics who I guess you believe have headroom then? Like at some point you is there a metric for like
Hmm.
penetration of the tribe that you're like, ah, forget it. You guys have done as bad as all you can. Or is that never the case?
Yeah, yeah. I think the way our sweet spot tends to shake out is that it's almost always somewhere between 20 to 70 million of revenue is the right time for us to get involved. And it depends on the price points, the categories, etc. I won't bore everyone with all the details as to why. That's the sweet spot. But the long story short is this: for us, we're not venture investors, and we're not traditional private equity.
Hmm.
So, in fact, I think one of the reasons why we started Provenance wasn't just to capitalize on the tribe dynamic that we were seeing. It was that we kind of wanted to end the tyranny of the barbells of the mentality and find the right middle path for brands. So, what do I mean by the tyranny of
I
the
love that
barbells? It's
theory.
like it's like everybody always asks us, "Are you a VC or a private equity firm?" And we kind of
Yeah.
say we're we're capital that's designed for omni-channel brands.
Yeah.
Uh, uh, we always get asked, "What do you care more about, growth or profitability?" And I say, "Yes." It's about how you balance those two over the long run because you're going to start from high growth and you're going to evolve to high profitability, and it's
Yeah.
about managing that transition over time. That's critical. We also get asked all the time: Are you hands off or are you value add? And and so to me, I say neither one of those is the right answer traditionally because lots of times when you're hands off, there's no value add, and why do you need capital from somebody who's going to not add
Right.
value to your business? Um, but when somebody is value add, you often connote that with being highly intrusive in your business.
Right.
um, we get asked, do you care? Do you believe in digital or physical? What's the future of uh, quantitative or qualitative? What matters more in investing in consumer brands? Like all of these things matter, and,
Yeah.
and it's not binary about one side of the equation or the other.
Right.
And what we're trying to do is marry all those things, but be very precise about
Yeah.
what's happening for a particular brand, and not give generic advice. We always try to give very specific advice based on very specific data that we're seeing.
Yeah.
So that's all backdrop to say, the sweet spot for us is somewhere between 20 to 70 million for a couple different reasons. One is that um, when our data becomes incredibly precise is around 20 million of revenue,
Huh.
where and what the tribe gets locked in pretty early, as I mentioned, maybe as early as 10 million of revenue. We can see that get locked in at that stage. Where the quantitative side really gets locked in is around 20 million.
Okay.
And what I'll tell you about our predictive analytics is that uh, we've back tested our portfolio companies on this, but our predictive customer lifetime value metrics are accurate to within plus or minus 4% in a 12-month time frame.
Nice.
So, but when you have about 20 million of revenue and that scale, the data becomes extremely statistically significant. So
Yeah.
again, when we're giving advice based off of that information, we can be highly confident that we're giving the right advice.
Yeah.
So, but the real point at which we like to get involved, and it's anywhere between 20 to 70, is that we call it the awkward, gangly adolescent phase of the brand. When all this data starts to become locked in, all the behaviors start to become locked in, but it's not a fully formed adult yet. And just like in real life, the choices you make during adolescence can have a pretty profound impact on the rest of your life. The same is true for a brand. And, what we saw in the capital landscape is that, there's lots of early stage folks who, just like every infant, there's no such thing as an ugly infant. They're all
Yeah.
they're all cute, adorable, and full of potential. Well, you can kind of say the same thing about brands at their infancy. Um, and then, when we look at private equity, which is where I came from, it's all about the resume. What have you done? What have you accomplished?
Right.
And we're going to judge you based on your accomplishments, not your potential. So we try to get involved at that stage where we can have a meaningful impact on the future trajectory of the company, both the revenue trajectory, the profit trajectory, or both. And that's the ideal stage that we can get involved.
Yeah.
Um, it, and it's also the stage at which we don't have to be running the company. That's not what we want to do. There's
Right.
no part of us that wants to run the company on behalf of the founders and their team, but it's where we can provide this very specific advice that's both strategic but also gets into very tactical advice, where it's very meaningful to the company, and um, and we can have an outsized impact at that stage.
Well, that's interesting because I had those two questions. I was like, why when you were going from Brentwood to Provenance did you want to go earlier stage? And then you said minority, and I was like, whoa, okay, that's I want to hear the answer for that. Um,
Yeah. Well, the truth is, look, capital loves scale, right? Uh,
yeah,
Whenever something's working, people want to do more of it, have more scale.
yeah,
So all things being equal, whether you're a GP or an LP, um, people want scale. Uh, in my view, in consumer, uh, if you're looking to balance risk and return, in my view, best risk adjusted return was happening at the stage that we're targeting.
yeah.
Um,
Interesting.
it's not that you can't make outstanding returns on the early stage side of things. Um, there are folks who are really good at that. I don't happen to be one of them because I don't understand how to take venture risk without the data.
Right.
Um, and we're basically getting involved as early as we can while we still have a high degree of confidence in the data and therefore also our recommendations on what they can be. The minority piece, again, if we if we were just looking to deploy the biggest checks we could, we would be looking to do change of control deals
Yeah.
because you can just deploy more capital in doing those things. But we felt like as digital is the primary channel that most brands really get their start on. That's what allows us to get access to all this data. If you're starting digitally first, generally speaking, you know, when the company's still in a rapid phase of growth, the founders aren't looking to sell.
Right.
They know they've got something on their hands, and there tends to be a little bit of an adverse selection problem if you're trying to force a change of control deal
Interesting.
on them, just
Yeah.
because you need to write a bigger check. So we just wanted to have the flexibility to be able to find the best next generation brands that we could. And to me, I felt like that was going to be taking significant minority stakes as opposed to majority
Yeah.
stakes.
Yeah. Interesting.
Yeah.
What as you size the okay, so let me see if I'm getting this right. That you size the tribe. The goal is sort of maximize the lifetime value out of the tribe. 20% of that tribe is really going to drive it, but you still need to attract and win the 80%. How then? How does that change? I mean, that runs so counter to sort of a lot of the conventional wisdom of like, oh, get into Target and then get in all 2,000 doors and then go get in Walmart and do all that and then you've made it. It it's like, or is it? I don't know. It feels like it's counter. It feels like you're sort of just like focus on your tribe and then focus on the 20% within the tribe that are really driving this thing. Am I getting it wrong?
Yeah, no, I don't think you're getting it wrong. What we're saying is not that you should fire the 80% of the customers. Uh, you're always going to have those customers. Uh,
Yeah.
but to me, the definition of strategy in consumer is focusing on the core customer. Everything you're doing is focused on attracting the core. You're still going to attract everyone else who isn't as loyal, who isn't as valuable. You're still going to do that. Doesn't mean you fire all those folks, but in terms of how you're prioritizing your efforts, your branding strategy, your marketing, your product development, your
Mm.
channel, all those things, it always focuses on the core, and then everyone else follows.
Hmm.
So that's the most efficient thing to do if you're trying to balance growth and profitability while maintaining your brand soul. In
Hmm.
my view, that's the only way to balance all those objectives is focus on the core, let everyone else come along a little bit for the ride, um, and but it doesn't mean firing everyone else as
Yeah.
customers. So
Is
yeah,
there,
I'm not sure if that was answering your question.
no,
I
it
think I was
is.
answering half of it.
No, it's such a cool idea that I'm interested in exploring it because when you were talking, you made me think like, how do you know? Like, you're doing customer acquisition, right, as a brand, and you've acquired the cut, and you're like, okay, so now in my power law, this is still an 80%er because they've only purchased from me once or twice. How do you know when they've moved into the 20% of lifetime value? Because like, can they ever catch up to the people that came in earlier who are producing so much lifetime value? So there's sort of a metric or an idea that you're able to move your new people into the core. Like, how do you know you're doing that successfully?
Yeah, yeah. Generally, you won't know until they've made their next purchase.
Okay, so
And
it could be as
so,
simple as like two or three purchases, and then okay,
yeah,
interesting.
so when you're being really accurate about that, like how and when they make that next purchase has a big impact on their predicted future value. So I won't bore you with all the details on how all that works, but the statistical jargon on it is it's Bayesian updating. I'll leave it at that. But how and when that next purchase happens has a profound impact on that. I think some folks are working on kind of a machine learning, artificial intelligence approach to trying to predict in advance before they've made that second purchase who's
Yeah,
most likely to, based on other data inputs. Um, I'm not sure yet that I've seen enough that that's going to be highly predictive consistently across a lot of different companies. Uh,
yeah,
Machine learning needs a lot of training,
right.
and every situation is different. So, by the time we're getting involved with brands, there's no time to train a machine on all the data inputs for as
Yeah,
long as we need to inform those things. But I do think the world is moving in that direction where
yeah,
eventually you'll be able to start to predict a little bit better even before they've made their second purchase.
yeah,
And frankly, even before the first purchase,
hmm,
who's likely to be a better customer. But I don't
yeah.
think we're at that stage yet. But people are working on that problem.
Do you think that the act of making that second or third purchase changes the customer's perception of the brand? You know, or I mean, one way to look at it would be like, I really like that sweatshirt. I bought another one because I really like the sweatshirt and I wanted it in blue. But another way would be like, hey, the fact that I had one interaction that I liked, I now had another. Am I building a relationship? Does it change the tribe dynamic, or is it just kind of like sell them a blue one if you can?
Yeah, well, I guess the answer is it depends. I think if you're thinking about it purely quantitatively, I think uh, it's more of an indicator that that brand love exists. Um, but how that second purchase happens does have an impact. So, just to give some examples, like, in the case of Marine Layer, one of our companies, the company started off at, in 2010 as a t-shirt business. They just wanted to create the best, most well-constructed t-shirt possible. They pioneered some fabrications to make that happen. People fell in love with the t-shirt, but now t-shirts are a fraction of the business.
Hmm.
So giving the folks other things other than just the world's best t-shirt
Yeah,
was profound in what the brand has become today. So, how people engage, what is the next product that they get to fall in love with? Yes, those things absolutely matter. And, um, how that's done, I think uh, there's lots of different ways to keep drawing the customer in. You can do it with product, you can do it with, deep engagement
yeah,
on a number of different levels. There's lots of different ways to draw that customer in once they've made that even deeper once they've made that first purchase. But the answer is yes, it does have an impact both on how we think quantitatively about what their relationship looks like, but more importantly, from the brand's perspective, like making the customer fall more in love with you.
interesting. Anthony, for the founders or people that are early, they haven't quite hit 10 million, let's say. What
Hmm.
are some key things that they should be thinking about to get to 10 and then be in a good position to get you guys interested?
Yeah, so I'm, excuse me, obviously biased, but I would say as early as possible, start figuring out who your tribe is and who you think they are. And even if you don't have some of the toolkits that we have available to us, start figuring that out really quickly as best as you can, because that should shape everything you're doing from then on. So, in some cases, if you need our help, we're happy to help friends of the firm on that front. Uh, but if you want to do it on your own, please do try to focus on that because that's what a brand is all about. It's about
Yeah,
making an emotional connection with the end customer, and you have to know how you're doing that and with whom you're doing that. The second piece that we see that is often overlooked by founders in the early stage is that margin is incredibly important, and not just product level margin, but what we call for shorthand shipped margin.
Hmm.
What does it cost to deliver that product to the customer?
Yeah.
um, and in the case of digital, directly to their doorstep. So we see that historically founders have focused way too much on growth and not enough on margin.
Yeah.
And people often underestimate how profoundly important that margin is to be
Right.
able to sustain that growth. uh, the third thing, which is very much in your control typically, is as long as you have reasons for the customer to keep buying, is the best businesses are always built on the foundation of the customer coming back, the repeat purchasing. And so, again, I think in the prior 5 years, we've seen too many people trying to add to the top of the funnel,
Yeah.
as opposed to focusing on retaining the customers they already have and making the customers that they already have that much happier. So, all those things are to say, focus as much as you can on profitability first, because once you know what your profitability profile looks like, then you can be rational about how you want to drive the growth.
Hmm.
And I think too often in the last 5 years, people have been focused on the growth first and
Right.
deferring the profitability equation till later, saying that's a scale problem. We'll figure that out when we're at scale.
Yeah.
And oftentimes that's too late because the wheels start coming off when
Yeah.
you've deferred that focus for too long.
Yeah. That's interesting. So, have you ever had a prospective company come to you with all three of those wired?
Uh, I'd say that all of the investments that we've made so far have all those fundamentals in place. I'd also say that none of the companies we've ever invested in has been fully optimized on what they're doing.
Yeah.
We always see that there's meaningful low hanging fruit that they haven't gone after yet. And that's our job, is to help them go after that lower hanging fruit. In some cases, it's on the profitability side. In other cases, it's the customer acquisition side. In other cases, it's the retention side. Everybody has areas of opportunity because uh, I don't know. It's it's like there's never been a perfect human being.
Right.
Like why is it our expectation that there should be a perfect brand? Um, uh, Even if it's the perfect brand and how it's positioned for a particular category, it's it's really difficult to expect, a rapidly growing company with a founder, as you're trying to keep up with the growth, to be nailing the execution on all levels.
Yeah.
So that's why we actually enjoy helping, because we don't view it as a shortcoming. It's like, of course you're going to have that. Like, how can somebody have a fully optimized business from inception? It's like
Right. Yeah.
it's too hard. There's too many things you have to do too well for that to be the case. So yeah, but we don't do what we would label brand turnarounds,
Yeah.
where the brand doesn't mean anything to anyone, and then we're desperately trying to find ways to make it mean something to someone.
Right.
That that we're not arrogant enough to think that we can create, because I think there has to be some real magic there, some real authenticity about why it's resonating with that end customer. We can't create that. That's what the founders and their vision create. We
Yeah.
can't create that.
Well, it sounds like I was going to ask you what you get. You have the opportunity to see so many brands and founders and leaders. It sounds like one commonality of success is a really great feel for the tribe, like an innate sense of what that tribe needs.
Hmm.
What other commonalities of success in those teams or founders do you see?
Uh, this is going to sound really basic, but there has to be a passionate belief in what it is you're doing, and why it is it matters. Uh, so I think in my career, 26 years of doing this, there's been one investment that I've ever had that sort of resembled a straight line the entire time. Uh, every other situation has been a wild, winding road of certain things didn't go your way, certain things went way better than you thought. Um, it was always about reacting to those things, and it's really hard because building a brand. Somewhere along the line, I don't know where people got the expectation that brands are supposed to be built in 3 to 5 years. Um, great brands are built over 10 plus years.
Decades, yeah.
And yeah, and it takes a lot of fortitude to see your way through all the ups and downs that come over a decade plus of different macro conditions, different supply chain conditions, different competitors, like so that singularly focused belief on what we're doing matters,
Yeah.
and we're making a difference. Whatever the source of that is, I think you have to start with that. And otherwise, people will want to throw in the towel at the first sign of a bump in the road. And
Right.
that's, I think we joke about it. It's like we, when we're investing, we always say, you're not really close to closing unless it feels like the deal has almost died at least once. Um, and every founder will also say that, at the end of it, even if it's a highly successful journey, they'll tell you the story about how they almost went bankrupt and they
Yeah.
had to get really creative on how to save it.
Yeah.
And
Interesting.
so, it's that fortitude that has to be there, and usually that fortitude comes from the founder, who then propagates that same belief to the senior team, who then propagates it to the rest of the team. In terms of what we tend to look for, as a predictor of success, people always assume that we start with LTV to CAC, like that's our first metric that we're going to look at for a digital business. And what we actually say is it's the shift margin for their category. And it's so profound that we kind of we've coined certain things in certain categories. Like in apparel, we tell everyone there's a 50-50 rule. And that 50-50 rule means this: if you have a 50% shift margin, and by shift margin, what we mean is contribution margin before marketing expense.
Okay.
So all the
Yeah.
variable cost that goes in, but
Yeah.
before the marketing expense. Uh, if you have a 50% shift margin and you're going to be truly an omni-channel business, um, with all the complexity that comes along with it, you probably won't really start generating meaningful EBITDA and profitability until you're north of 50 million in revenue.
Interesting.
I, I've seen that very consistently over the last 20 years. Digital has not changed that.
Interesting.
It really has not changed that dynamic. There are certain exceptions when certain brands just catch fire and they don't have to spend a dollar on marketing,
Right.
and they're riding a wave of consumer awareness and demand. Those are the exceptions, not the rules. I'm talking about everyone else who actually has to have some combination of the word of mouth and some combination of uh, building it brick by brick,
Yeah.
whether it's digital, physical, or what have you. That 50-50 rule comes into play a lot. So uh, every brand we've ever invested in uh, typically has a very high net promoter score. And net promoter score isn't something that we live and die by, um, but we care more about the behavior and the customer loyalty piece, and what that Net Promoter Score actually translates into.
Yeah.
Uh, but we've never invested in a brand that has one less than 70. We've invested in brands that have scores as high as 88.
Wow.
But there has to be a lot of customer love there, and there's a lot of indicia we look for that, because again, that's the magic that we can't create. The data is
Right.
not going to create that. Um, it's the founders who create that magic. So with those things, I think uh, the other things that are within founders' control, um, it's a, a firm belief in team building. The
Hmm.
team and culture matter. Um, if if founders don't believe in that, then I don't think they can really have an omni-channel business successfully. Um,
Interesting. Because it's
so
so complex and hard
the,
to manage.
yeah, and the final thing I think we care about is a deep sense of alignment around what it is we're trying to accomplish and what the definition of success is.
Yeah.
So for us, that means um, one thing we've become known for, that's a little bit different than most other folks out there, is we use our data to start to craft what we believe is the best risk adjusted growth plan for the company.
Hmm.
And we take that, and it's not just in isolation. We present the first draft of that with the company, they'll tweak it. But once we have alignment about that, that's when we know we want to do the deal, because it's not just about being successful or not. It's about what risks you're willing to take to get there, and what work you have to, being aligned about what work is required to get there,
Yeah.
and who's doing what, and who's going to help on what. So um, we also care about founders who uh, care deeply about alignment of those outcomes. And
Yeah.
it's usually having also sharing a common vision around uh, when everybody defines as the right time to exit. Not that you can predict the future and predict what market conditions are going to be 5 to 6 years out, but
Right.
at least directionally, you have to be aligned about when when you can be satisfied with the success you've had, and
Right.
when you can start to talk about those exits.
Yeah.
So I know those are all incredibly generic, uh, but it truly is how we measure like the likelihood of us wanting to do something, because it's not just the quantitative metrics, it's not just the size of the
Yeah.
tribe, it's about how we're going to get there from point A to point B that defines what our relationship is going to be like.
Yeah.
And
That's awesome. I mean,
so,
that's like, what is that? Like 30 years of experience? 20. So that's
yeah,
an incredible
coming up on
amount
it.
of like, insight right there. I like to craft those. That's really cool.
Yeah. Well, I'm very fortunate because our team here is super passionate about all the things I just talked about, not just the data piece, but also passionate about wanting to help the companies. Because look, it's easy to look at helping the companies as an annoyance and as a time suck,
Right.
but we don't view it that way at all. We view it as we get the privilege to actually be invited to help our companies. And when they want our insights, when they want our help, we view that to be flattery, not uh, a necessary evil. Let's put it
Yeah.
that way.
Yeah. Anthony, thanks so much. This has been terrific. It's really fun and informative.
Thanks so much for the good questions, Ben. I wasn't sure what to expect from this, but thank you for asking some super provocative and interesting questions.